All right, guys, this is our video number 3 and our last video. Imagine that. You're pretty much done with the semester. This is it. How excited you must be. I'm sure you can't wait to be done. Okay, so here we go. Monetary policy tools. When the Federal Reserve wants to increase the money supply, it means it wants to increase the real GDP. This is actually what it's trying to do. We have a recession of some sort. We need to increase employment, real income, investments, and total productions, which basically means the real GDP. The way they increase the money supply, purple arrow, purple, is reduce interest rates to stimulate borrowing, because borrowing translates to an increase in total spending. Total spending is the bloodline of an economy. When you increase that, you increase the well-being of the economy and its capacity. Reduce required reserves, not very popular. They don't touch it very often, but they can. What it means is they make that 10%, let's say 9%, and that frees up 1 additional percentage point to be lent out in excess reserves. More loans, more spending. Purchase securities. We do know that when they purchase securities, what they're doing is they're putting money in the hands of people. They're basically encouraging people to spend instead of save. That increases total spending and therefore the real GDP. And they print more money, and this is that fractional reserve banking. They print money, they put it in a checking account and watch it grow by allowing the banks to create money via the excess reserves. Now, when we have the opposite and we have high inflation as we have right now, we're looking at decreasing the money supply. And so the Fed has been definitely tightening. So quantitative easing is what's happening over here, and this is money tightening is what's happening. Quantitative tightening is what's happening when we're going down. What we're reducing is inflation. But when inflation goes down and the measures are executed to reduce inflation, it can very well reduce employment, real income, investments, and total production as well. It's a consequence. So all these 4 tools, they're reversed. Interest rates, what happens to them? They're raised. It's what's happening now. The higher the interest rates, the less we are encouraged to spend and the more encouraged we are to save. So increasing interest rates ends up encouraging people to back off borrowing. Increasing required reserves instead of 10%, maybe making it 11%. That restricts excess reserves, less lending, less spending. Sell securities. Selling securities, you're telling people, take that $10,000 that you have right now and put it into a security that's guaranteed, that will not be used, will not be spent or liquidated for X number of years. And what you are doing as a Federal Reserve is encouraging people to save, which means they're spending less, which means inflation is cooling off because we're not rushing to the store every 5 minutes trying to buy small, medium, and large purchases. And then remove money. Remember, the money creation process actually works in reverse. So if the Fed deducts money from checking accounts that they have, then all they will do is reverse the availability of money to be lent out, and that reduces spending overall. So you can see the importance of the Federal Reserve, using these 4 tools in a timed way. A little bit of a transmission of money here. So the FOMC sets federal funds target range, right? And then it affects current and expected short-term interest rates. This is what we're talking about up here. It affects long-term. This is more like, mortgages. Influence consumers and producers' spending decisions is what we talked about. And then progress made toward maximum employment and stable prices. Because the whole point, the Federal Reserve's job really is to focus on inflation. Now, they try very much to boost employment, but it's really inflation that is their domain that they have to get under control. So they shoot for that under 3% inflation. Now we're on to the 8 functions of the Federal Reserves. Don't confuse them with the 3 functions of money. This is what the Fed does. Okay, here are the things that the Federal Reserve basically does. The Federal Reserve controls the money supply. They decide how much money there's going to be and the value of that money. They supply the economy with paper money. Coins, which make up about 1% of the overall money supply, are actually minted by the Treasury. You can check out a coin next time you have one and pay attention and see that it tells you it's the Department of the Treasury that actually released it. Provide check clearing services. What is that? If my bank is Bank of America and your bank is Chase Bank and I send you a check, who's going to make sure that my bank pays your bank by midnight so all the funds are cleared? That's the Federal Reserve's job, to make sure that banks settle accounts with each other on a regular basis. hold depository institutions' reserves. We're telling banks, or the Fed tells banks, they have to hang on to 10% of all the checkable deposits. Well, where are they going to put that money? They have the ability of storing them at the nearest Federal Reserve Bank, and that way the Fed is going to be safeguarding them more with more security and less insurance required. Supervised member banks, they audit banks on a regular basis to make sure that, they're doing what they're supposed to do and there isn't some, shady business going on. They serve as the government bankers. They also give banks over here a supervision stress test to see, should a lot of withdrawals be required of this bank? How will this bank actually survive? Will it be able to do what it needs to do, or do they need to declare them insolvent? Serve as the government banker. If you have ever received a check from the IRS, it was drawn on a Federal Reserve Bank because that is who the government banker is. So when the government collects money, it puts it into its own bank, right? They're not going to put it into like, I don't know, TD Bank. They're going to have their own. That's called the Federal Reserve. And when they're paying out anything, they're also sending those checks out of their own bank. Serve as lender of last resort. When banks borrow from other banks, but when a bank that refuses to lend to others, meaning there's a bank that wants to borrow but they can't actually acquire the funds the normal way, they can go directly to the Federal Reserves and say, we need basically special accommodations, or we're going to run into issues. Sometimes during dire financial circumstances, like for instance when Ben Bernanke was the chairman of the Federal Reserves and we saw the Great Recession, he was like, come to Papa, bypass the banks, come directly to me. I want to give you money quickly and I want to make sure that the economy accelerates and moves forward. Serve as fiscal agent for the Treasury. The Treasury and the Fed work together very closely. Usually the heads of those two departments meet and have at least one lunch or one breakfast a week, and they discuss things, and they collaborate quite often because it is the Treasury that is actually the discount window, not the Federal Reserve. So let's talk a little bit about that here. Think of the Treasury, as far as the difference between the two, as a budgetary agency. It is the accountant of the United States. Your accountant is the person you can go to and say, do you think I can spend this money? Do you think I should increase my income? Do you think I should put my money over here? Do you think I should buy that second house, right? You're consulting them about the money coming in and money going out. So the Treasury definitely has a big say if the administration that happens to be in charge wants to actually listen to its Secretary of the Treasury as far as, the financial well-being, how much it's going to collect in taxes, how many outlays it has, whether they need to increase the debt ceiling or what's going on. The Federal Reserve, on the other hand, short for the Fed, is a monetary agency. They are the banker of the United States. You can see that if your banker is also your accountant, there's a conflict of interest. That's why these two are actually separated. So when it comes to things like printing, issuing, minting coins, or issuing securities, Treasury securities, this is the Treasury. When it comes to things like printing money, removing money, destroying money, adjusting interest rates, if it has to do with money, it's the Federal Reserves. If it has to do with collecting income, revenue, or outlays, that has to do with the Treasury. So the U.S. Treasury and the Federal Reserves are separate entities. The Treasury, of course, the Treasury is the older institution of the two, manages all of the money coming into the government and paid out of it. Money coming in, revenue, money going out, expenses. The Federal Reserve's primary responsibility is to keep the economy stable by managing the supply of money in circulation, the amount of money and the value of money. So they work together. You can see how these are two teams that must come together and collaborate and have a consensus and clear communication, but they are two separate departments. Okay, guys, it's been a pleasure. I hope you have a wonderful rest of your semester, of your life. I hope you thrive, and I hope you end up being people who lead meaningful, purposeful lives. I will miss you. Ciao.